Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. The fighting in Israel continues, but currently we aren't witnessing major safe haven moves. Gold is up 3%, but dollar, which has traditionally been the safe haven rhetoric, is down against the majors. JK, what would be the narrative driving the currencies forward?
Good morning, Swaraj. I think we had the big weekend news of the war breaking out in the Middle East, but uh, as things have intensified with Israel reacting strongly, actually markets have had a limited fallout. While the big human toll is quite unimaginable, the assessment is that the latest outbreak of war is likely to be not such a big risk to the long-term investors. That seems to be the conclusion of the market, and everyone is back assessing the economy, watching the words of the Fed speakers. In fact, if you look at the past geopolitical events involving Israel, it shows that there have been muted moves in the US and the international stock markets, and the initial reactions were reversed within 5 days. That's what the history and data shows. Now, what started as a safe haven buying in the US treasuries has continued, and 10-year has been down by 25 basis points from 4.88 to 4.63. 30-year similarly from 5.05 to 4.81. It's a value buying of treasuries, particularly in the context of stock market question mark over the valuations. At the same time, yesterday US equities were starting off with a risk of sentiment, but took a U-turn, a big U-turn. In fact, the S&P 500 opened down 0.5%, but halfway through the session, it staged a smart recovery and moved back into positive territory, gaining 0.5%. Nasdaq was also down, but gained 0.38% overall. The regional European indices closed in the negative territory, but perhaps looking at the way the Asian markets have been firm today, Europe will have a positive move as well today. Helping also the sentiment was the US Fed speaker, Mr. Logan, who said that long-term, the higher long-term rates mean less need for rate hikes, and markets are doing the job of the Fed. That is how he interprets it. Now, if we come to the currency, obviously the biggest hit was taken by Israeli shekel immediately after the war started. But even that subsided as the Bank of Israel said that it planned to sell 30 billion of foreign currency to mitigating the uncertainty and moderate the volatility in the market. In fact, they have almost never sold foreign exchange to control the shekel movement, and market took it quite strongly, and Israeli shekel ended the day only with 2.5% loss. Now, safe haven buying of dollars has been limited, and investors who preferred the bonds and which are yielding multi-year high returns, and gold that has seen a very good correction of over 10% in attracting some money. These are factors that have drawn investors back to selling the dollars and buying back the currencies. In fact, China returning from long holidays has seen even the yuan remaining stable, and it's actually testing a crucial level of 7.27. I think one of the things that is also driving the currency market in a big way is the net long position on the dollar, which has risen to 1-year high according to the CFT Commission data. And we know that dollar had risen almost 7% in the last 3 months, and that seems to be the reason behind the markets coming back to buying the value buying in the currencies, like particularly like Aussie dollar, Canadian dollar, who have had a very good run in the last 2 days. Of course, the more sustainable moves seem to be confined to oil and gold. Oil prices have retained most of the initial gains, with both the Brent and WTI up close to 4%. This spike will probably sustain until the situation eases much more, and people also wait to see whether the conflict gets wider, whether countries like Iran are involved, because that can be a threat to the supply side of the oil. So oil will remain higher, probably higher for longer. In oil prices can be some theme in the coming days. As far as gold is concerned, the market had lightened up its position a lot in the recent days, which fell to 1810, creating value by opportunity. The war news obviously triggered the impressive gain of 3% in the yellow metal. And with potential for dollar weakness in the coming days, gold can easily gain some more towards 1880 or 1890. On the rupee, we did see the weakness almost towards its all-time lows in onshore markets yesterday. But the presence of PSU banks selling dollars at the highs averted breakout. Sell-off in domestic stocks did reflect the global sentiment, and FI flows were negative. But the strong buying in the USD INR from foreign banks, purportedly on behalf of the FIs who were selling stocks, was met due to the selling from PSU banks. Now, as long as the 83.30 level is not broken, I think a market is unlikely to go long of dollars, having seen the strong presence of the central bank at that level. At the same time, continued recovery in currencies, or rather fall in the dollar against other currencies, could actually drive up the rupee a bit towards 83. And maybe some of the pent-up flows can come back and create some breathing space for the rupee bulls. So expect some recovery overall in all the markets. And yes, we should keep an eye on the war situation and be nimble about committing too far in the asset classes. Thank you.
Thank you, JK. And majorly what I'm getting as major themes is that the fallout from the war with respect to market reaction has been quite limited. I think the assessment of the markets is that the war will not be a threat to long-term investment, and focus has once again sort of shifted back to economic news. We are seeing some fall in yields as value buying of treasuries, US treasuries continue, but oil prices have retained most of its gains. It is expected to sustain till the time there is clarity on the geopolitical front. And when it comes to our rupee almost tested its all-time lows, but PSU banks were quite active to curb any excessive depreciation. But a broad dollar weakness can lead to some sort of appreciation for the rupee. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.